Trump sends gifts to the markets for a change. India's trade agreement with the United States shaping up very nicely. And why is everyone hating Nvidia? This is Vinay Uttam, your resident stock doctor, and welcome to a brand new episode of the Stock Doctor podcast. We are on episode 125 this week. So inching closer to the 150 episode milestone, still a long way to go, but we're halfway there. Now, I have a feeling the show has been a very lucky charm for the US markets in recent times. And I'm not so bragging. I'm going to give you some facts on it, all right, before I move on. Now, normally these shows are recorded on Tuesdays these days. There's a new time for it on Tuesday. Now, when I record the show, as I'm recording the show, markets either finish the day on the red or they're flat or they tend to be, they tend to be all over the place. Once I finish recording it and I tell you, oh my God, the markets are really bad, what do we do? It's insane and all of that. For the rest of the week, they just keep defying gravity going up. I mean, no, I don't know what's going on. I mean, I'm only kidding when I say it could be a lucky charm, but President Trump's post messaging driven market is, it's been a crazy ride, is all I'm trying to say. I'm only kidding. I mean, it could be a lucky charm, could not be lucky charm. I don't know. As I'm recording it, probably no jokes, guys. As I'm recording, the futures are up. Yeah. Futures are up. I'm telling you, once I finish recording, once we look at Tuesday's market action, don't be surprised if it's in the green again. Okay, now remember I told you, and let me give you a little bit of a background, or let me give you a little bit of insight on why I think this is President Trump's, post-driven or tweet-driven, or whatever you want to call it, market in recent times. Now, I told you last week's episode that the central bank, the Federal Reserve's independence was at stake. Yeah. I told you this on Tuesday about Monday. It only lasted for Monday. As the sentiment, was boosted by President Trump significantly dialing back his aggressive rhetoric against the Fed chair, Jerome Powell. And from Tuesday onwards, it was a positive ride for the markets. I kid you not. The moment I finished record, Tuesday, it ended up in the green. As I'm recording, looking at the US futures, they're still in the green. Obviously, there were also some solid earnings last week that drove some positive momentum into the markets again, such as from the likes of Google parent Alphabet, which I will be covering in the coming weeks, a full Dr. Dissect segment on it. As we gear up for a week of reckoning, thanks to earnings reports from 4 of the Mag 7, we have Microsoft, Amazon, Apple, Meta, all reporting later this week. Let's take a look at the key developments that transpired in the week gone by. One that saw all 3 indices ending up firmly in the green post-Monday rally, with the Dow jumping 2.5%, S&P 500 advancing 4.6%, and the tech-heavy Nasdaq cruising 6.7%, ending the week up 6.7%. So without further ado, as always, let me welcome you to the Doctor's Weekly Snapshot to talk about the developments in the week gone by. One that was dominated by tariff talk once again. However, for a change, and this is why I keep selling, the title of the episode is President Trump Gifts Markets for a Change. It was positive tariff talk across the board, and at the same time, like I mentioned, he aggressively dialed back the rhetoric on Fed Chair Jerome Powell, which also boosted the market. So fingers crossed. Once this episode is recorded, we have another green week. Yeah, let's find out now. The reason why it was again dominated by tariff talk, I mean, the reason why I keep saying it was dominated by tariff talk and was a positive week is because within 24 hours of sending a cryptic message about wanting to fire Fed Chair Jerome Powell, President Trump categorically said that he has no intention of firing Chair Powell. Trump expressed his desire for Powell to be more proactive in lowering interest rates, but categorically clarified to reporters, I have no intention to fire him. Those were the magic words that the markets were waiting for. And so that was that. Markets rejoiced upon hearing that the central bank, the Federal Reserve's independence, is not at risk anymore. Thank you very much. Off to the races they went. While President Trump clarified that he wouldn't be firing Chair Powell, it still has left investors, if you look at the interviews by top fund managers and so on, it still has left investors question to what extent the Fed's independence may have been tarnished through all these recent attacks. This is because the president's accusations would imply that the Fed is not acting independently, but is instead motivated by political considerations, a narrative that could delegitimize the institution in the public eye. So we still don't know. I mean, let's say Chair Powell completes his term as per decided on May 26th. What happens when the next guy, presumably the guy called Kevin Warsh, is expected to be the next Fed chair? But all his moves, is the market really, are investors really going to look at it as independent moves that he's making? Or do you think that a part of the market, or there's a part in the markets that think maybe President Trump is whispering in the Fed's chair? So all these attacks, they may have, I mean, the dial down rhetoric might have saved the central bank's independence, but it definitely, in my opinion at least, has tarnished the Fed's reputation. And it's just not me. If you look at all the interviews, there's a legitimate question among economists, investors, and even policymakers to look at whether, the question is, has this tarnished the reputation of the central bank, the very, whose very independence is very much required for the markets to remain, at least there is to instill some stability in the markets. Put simply, these efforts to discredit the Fed could have lasting negative effects, eroding the bipartisan trust that underpins the central bank's authority and, more importantly, maneuverability. The maneuverability, by that, what I mean is like basically their decision to be data dependent or not, their decision to raise rates or not, their decision to do quantitative easing or not. All of this, is it going to be determined? I mean, can investors really trust the moves that the Fed, not just today, but in the future, they're making? Is it just out of their independence, or is it someone whispering in their ears? We have no idea, you can't really say now, can I? I mean, there's a question mark now. There's the question mark that's put in, and that will always be a little bit of a problematic scenario if things, get a little murky going in the week, in the future. While I'm in no way, shape, or form suggesting that is the case right now, today I'm not saying Chair Powell. I think Chair Powell has stuck his ground, has held his ground. Got to give the guy a lot of respect through the attacks. He didn't once say anything back. He simply said that I don't think anyone has the authority to fire me. The president has the authority to fire me. And obviously, he's also hinted that he will be going to the court should such a scenario play out. And so while I'm in no way, shape, or form suggesting that the Fed's Fed Chair Powell is and his team are basically answering somebody else's call, investors, in my opinion, should still keep an eye out for any future comments made on the Fed, especially if it keeps rates intact as expected during its May meeting now. For now, the Fed and Chair Powell might not have a target on their backs anymore, but I have a feeling, guys, there is a lot to come after the Fed's May meeting. Remember, President Trump has been calling for rate cuts, rate cuts, rate cuts. The odds of a rate cut happening in the May meeting are not, are very minimal right now. The expectation is that they're going to keep the rate cuts unchanged. Should that happen, do not be surprised if there's another round of attacks, and do not be surprised if the reputation is at, if there is a threat that the reputation could be tarnished even furthermore. We don't know, but investors should definitely keep an eye out for, because during these murky times, especially at a time when tariffs are roiling the markets and they're driving the macroeconomic uncertainty, the threats of a recession have gone up. The Fed's independence is very much important. And more importantly, the Fed's actions could make or break the economy, not just the market, but the overall economy. So it's very important that investors keep an eye out for what kind of rhetoric President Trump takes on the Fed after the May meeting. For now, Fed Chair Powell and co are, have the targets of their back. And that's exactly why, one of the reasons why you saw the markets off to the races, defying gravity, a positive week indeed for them. Now, the clarity on Chair Powell's status was not the only gift that President Trump gave to the markets last week. In the same press conference, President Trump also addressed U.S. tariffs on China, stating that the current 145% tariffs are very high, but would come down substantially, though not to zero. I like the word come down substantially. We have no idea what that substantially means, but anything less than 100%, I think would be yet another off to the races moment for the markets. The possibility of tariff reductions further contributed to market optimism following the statements made by the president. At the same time, during the weekend, we also got news that the Chinese authorities have informed certain importers that specific U.S. goods, especially those difficult to source elsewhere, are exempt from the latest 125% tariff increases that China has imposed on U.S. goods. The exempted products include certain semiconductors and chip-making equipment, medical products, and aviation parts. Basically, the very areas where China remains dependent on American-made inputs. It doesn't matter what the motives behind this move are. Any exemption from either side is a positive for companies and, by extension, for the markets. This is because on the ground, the tariff uncertainties are quietly causing chaos amongst companies, and the effects are starting to see in the trade between US and China. For instance, the number of vessels departing China for the US carrying goods such as apparel, electronics, and furniture has absolutely plunged as many cargoes are getting cancelled. At the port of Los Angeles, a major entry for Chinese importers, officials expect a 35% drop in import volumes within the next 2 weeks, with shipments for major retailers and manufacturers essentially ceasing. No more. Supply chains are also changing, with retailers and manufacturers rapidly shifting their sourcing and shipping from China to other Asian countries such as Vietnam, Malaysia, Cambodia, and when it comes to companies like Apple, India. Importers with manufacturing options outside China are halting Chinese production and pivoting to alternative locations almost overnight, which have essentially brought Chinese shipments to a grounding halt, but a surge in bookings in other parts of Southeast Asia. So essentially, the US-China trade war, comments may drive the markets. Sometimes, how the markets react may not be a reflection of the reality. And the reality is things are not looking particularly great. And the tariff uncertainty is starting to cause chaos amidst, at the reality at the ground. As seen by a dramatic decline in shipments from China and a surge in Southeast Asia. That can cause chaos on its own, by the way. When you just switch your supply chains overnight, pivot, all of that, all kinds of crazy issues could emerge. One last bit that I got to say about the whole tariff, the tariff uncertainty. I told you chaos is caused by Chinese shipments. I mean, I gave you an example of Chinese shipments coming to an end, coming to a grounding halt as one of the chaos. With Q1 earnings in full swing, a pattern surrounding earnings guidance is also emerging that is proof that it's also causing absolute chaos amongst executives as well. CEOs from leading companies, including American Airlines, PepsiCo, Procter & Gamble, and others, have warned that constantly shifting landscape of tariffs makes long-term planning nearly impossible. And for long-term investors like us, like you and I, that's not exactly great news to hear. The unpredictability, according to these executives, is spooking consumers, leading to caution in both business investment and household spending. It has also led to some bizarre guidance formats have not seen in ever. United Airlines, for instance, issued a dual forecast, one for a stable economy and one under the possibility of a recession. I mean, it just reflects the depth of uncertainty, but boy, is it bizarre. Like, yeah, normal, if things stay X, this is going to be the guidance. If things stay Y, this is going to be the guidance. And as an investor, I'm like, what do I do? Weighted average? Like, don't be, I mean, executives are now being analysts. That's what's happening now. I mean, it's unheard of. But then again, we're living in an environment that no one predicted would be possible. Such has been the degree of uncertainty. The other takeaway from all that is that it is the unpredictable nature of tariff policy, not just the tariffs themselves, that seems to be the central problem. It's not about 145% or 125% or 90% or 26% or whatever reciprocal tariffs. No, it is just that today it's 145, tomorrow it's 120. We have no idea whether tariffs will exist tomorrow or day after tomorrow or 2 weeks from now, whether they cut down. It just causes chaos. It just simply causes chaos, and therein lies the problem, for executives, and therein lies the reasoning behind why such a bizarre guidance forecasts are coming. Can you blame the CEOs? Absolutely not. Can you blame the CFOs? Not at all. Can you blame the CIOs? Not at all. Can you blame the investors for causing chaos? Not at all. Can you actually blame anyone? Well, we can, but it's not a political show, so I'm gonna move on from now. Move on to the next part, which is there also seems to be a lot of pull forward that's taking place right now, because despite widespread pessimism about the US economy driven by political uncertainty, inflation, and new tariffs, Americans continue to spend at robust levels. Many Americans are accelerating purchases of big ticket items like cars and smartphones, anticipating higher prices due to tariffs. Conversely, they are cutting back on discretionary spending such as vacations. Affluent customers, obviously, who have been a key driver of recent economic growth, unsurprisingly, are still spending, buoyed by wage gains. Spending by the top 5% of Bank of America's customers grew about 3%, suggesting that even recent stock market declines haven't deterred their purchases. Now, the pull forward seems to be the main reason behind this paradox, given that the overall consumer sentiment and business confidence continue to deteriorate, and some of which are at an all-time low. I mean, even the latest Michigan, the final survey came at about 52.2. It was still pretty low, pretty bad. And the business confidence is at a 12-year low. So it's just the pull forward is probably the only explanation. It's not like people believe the economy is great and I'm going to have a lot of money I'm going to spend. No, they're like, we don't want to pay higher prices 6 months down the line, so we're going to buy more today, and that's probably driving the spending, which means the chickens might come home to roost 6 months from now on when we actually see a slowdown. Again, uncertainty, again, chaos, again, bizarre guidance, etc., etc., etc. Bottom line, I have to keep repeating the same thing that I've been telling you guys since President Trump's inauguration day, which is that volatility will be the name of the game going forward. Of course, I didn't expect such a volatile market. Don't think anyone did, but given the unpredictability of the individual who's driving predominantly this market action, investors shouldn't be surprised. In fact, there was a recent article on Wall Street Journal by Gunjan Banerjee, someone who I have great respect for. She writes brilliant articles. Definitely give it a read, is what I would say. That examined the surge in stock market volatility in April 2025, describing how dramatic swings, both up and down, have become routine for investors. April of this year is on track to be the most volatile month for United States US stocks since COVID-19 crash back in 2020. A pandemic and tariff uncertainty in the same sentence. Never thought I would say that. S&P 500 has moved at least 1% in 7 of the last 10 sessions, illustrating the market's extreme sensitivity to news. Both gains and losses have been sizable. For example, the Dow jumped over 1,000 points in a single day before settling up 419 points, while the Nasdaq jumped 2.5% and the S&P 500 rose 1.7% in a single session. I mean, these are crazy numbers, but whether you like it or not, they're here to stay. Such volatility is here to stay. I will keep repeating it until the narrative changes. Volatility is the name of the game. And this is why I keep saying, the other thing that I also add after saying volatility is the name of the game is, if you are a long-term investor like me, then it is important not to panic, especially if you have invested in high quality names. Any major correction in those names should be considered as buying opportunities, in my opinion. You guys can do your research, obviously, but in my opinion, they should be considered as buying opportunities. Speaking of such opportunities, there is a very high chance we might get one later this week when 4 of the Mag 7 giants report their earnings. You have Microsoft, Meta, Apple, Amazon. Microsoft reports tomorrow. I believe Meta also reports tomorrow. So if I were you, I would definitely be keeping an eye on the markets both during the build-up and once the earnings reports of the 4 of these Mag 7 companies have been published. Either way, I leave the segment with the same 2 words I've been saying for weeks now: buckle up. And on that note, we take you to the Doctor Goes Home segment. After taking a sip of the water, right. Welcome to the Doctor Goes Home segment. And there was more good news on the horizon for Indian markets, as there were major developments surrounding the bilateral trade agreement with the US, positive commentary on India from US officials, some positive economic data, and finally, with foreign institutional investors, FIIs, finding their love for the Indian markets once again. The major takeaway for me last week was the accelerated development seen in the efforts to finalize the bilateral trade agreement with the United States. Keep in mind that India continues to be exempt from the reciprocal tariffs as part of President Trump's decision to pause them for 90 days. What was supposed to be 26% currently stands at 10%, the baseline rate for all countries except China, which, like I said before, stands at 145%. I've told you guys time and time again that it's vital that India takes full advantage of this period, of this cool down period, to finalize the trade agreement so that it can escape the 26% tariff once the 90-day period ends. And that's exactly what seems to be happening given the developments of last week. For instance, on last week's episode 124, I told you that both India and the US are accelerating their efforts to finalize the first phase of a bilateral trade agreement, with negotiations gaining momentum amid a 90-day pause. The proposed deal currently under discussion is structured across 19 chapters and will address a range of regulatory issues, including digital taxation, tariff reductions, and non-tariff measures reduction as well. Last week, just the week gone by, this was further confirmed by US Treasury Scott Bessent, who indicated that India is likely to be among the first countries to sign a trade deal with the US, given its relatively few high tariffs and non-tariff barriers compared to other nations. The US Treasury Secretary also noted that the trade talks with India are very close, his words not mine, to reaching a successful conclusion. He attributed this to India's fewer trade barriers and lack of currency manipulation or significant government subsidies, perhaps an indirect attack on China there, but hey, I'm focused on India here, isn't it? Vice President J.D. Vance, US Vice President J.D. Vance, who visited India last week, also announced that the two countries had finalized the terms of reference for the negotiation, although he did emphasize that the need for India to reduce non-tariff barriers and increase market access for American goods continues to remain a question for a topic for discussion. When you put all these comments together and you put the overall direction at which the trade talks are going, there are a lot of positives for investors to take with respect to the BTA, the bilateral trade agreement. And the odds of India escaping any retaliatory tariffs once 90 days have passed have significantly jumped in recent weeks. I do want you guys to keep in mind, however, that despite these positives, it still might not be a straightforward process, given that sectors like agriculture, where Washington wants greater access, but India fiercely protects, continue to remain sticking points. It's not like a done deal, like just the signatures are needed. It's not done deal. It's far from it, but at least the talks are progressing in a positive direction, and that's what's more important, and that's what the Indian markets and Indian investors took on board. That was not the only positive. That was the positive news on the trade front, but it was not the only positive news that transpired last week. There was also more good news from the Reserve Bank of India. As the central bank's new liquidity norms, which recently got revised, are expected to boost bank lending by approximately 3 lakh crores, which amounts to $35 billion. The new norms will come into effect on 1st April 2026, next year, applying to all commercial banks except payment banks, regional rural banks, and local area banks. The RBI has reduced the runoff factor for retail deposits accessed via internet and mobile banking from a proposed 5% to 2.5%. Stable retail deposits will have 7.5% runoff, while less stable ones will have a 12.5% runoff. Moreover, deposits from non-financial entities such as trusts and partnerships will now attract a 40% runoff, dramatic decline from a 100% runoff. Now, you keep hearing me saying runoff, runoff, runoff. What on earth is runoff? Runoff factor simply refers to the percentage of deposits that could be withdrawn by depositors in any stress scenario. So a decrease in this factor, especially the 100 to 40% significant decline. So a decline in this factor means improved liquidity for banks as they will have more capital to lend. To be precise, the revised norms are expected to improve banks' liquidity coverage ratio by about 6 percentage points, enhancing their liquidity resilience. The increased lending capacity is expected to support the economy through cheaper and more accessible credit. Overall, RBI is leaving absolutely no stone unturned in its quest to turbocharge the growth in the Indian economy, as after reducing rate cuts, changing its stance to accommodative, it now has designed liquidity norms that would enhance the bank's ability to lend while maintaining robust liquidity standards, thereby supporting economic growth through increased credit availability. Yet another positive for investors to cheer. The recent positive news has not gone unnoticed, by the way, especially among FIIs, the foreign institutional investors, who appear to be coming back to the Indian markets with a bang. There has been a significant turnaround in the investment strategy of FIIs in the Indian equity market. In 2025, FIIs have generally been net sellers in the Indian market, with outflows totaling 122,252 crore rupees. This trend was observed in January. You had 78,027 crores. February, you had 34,574 crores. March, you had a 3,973 crores. Notice the significant decline. However, FIIs have recently reversed this trend by investing 32,466 crore rupees in Indian equities over just 8 trading sessions. In addition to all these positive developments in the Indian markets, as I mentioned before, a weakening dollar has also been a tailwind for increased FII buying. So overall, FIIs are back with a bang. And notice 78,000, they were still net sellers, but it came down to 3,800. And if the positive momentum continues in the next 2 trading sessions, there's a very high chance that they might even become net buyers for the first time this year. We'll find out at the end of the month. And as in more when data comes in, obviously I'll be here to present it to you guys. Bottom line though, the question then becomes, is it all going gung-ho from here? Is it an all bets are off scenario? Let's go crazy into the markets. Let's buy, as Mr. Kramer would say. Short answer, no. If you go by the latest RBI report, then there are still areas of concern. First, the BTA is nowhere near ready, as I've mentioned before. Positive developments, sure, but that doesn't mean the deal's done. Still expect there to be a lot of wrangling before we even get to the finalized version. In the meantime, India's exports to the US are projected to decline by $5.76 billion in 2025, representing a 6.4% contraction compared to the previous year. The RBI notes that global trade tensions exacerbated by the US tariffs will likely affect India's domestic growth and export performance. This could lead to increased pressure on domestic demand as exports decline. While India maintains a growth projection of 6.3 to 6.8% for the 25-26 fiscal year, the RBI cautions that the impact of tariffs and global economic conditions could complicate achieving these targets. Finally, RBI also highlighted the difficulty in quantifying the exact impact of these tariffs due to variables like export demand elasticity and potential policy responses from the Indian government. Don't forget, there have been rising tensions between India and Pakistan following the dastardly terrorist attack at Pahalgam, which has added more complications to an already complicated global picture. With the IMF also lowering India's growth forecast, citing tariff-related uncertainties, we are simply not fully out of the woods yet. The Indian markets have been off to the races in recent times, especially after the FIIs have come back with a bang. While largely the sentiment remains optimistic going forward, investors shouldn't forget that there are still challenges that could derail this optimism just like that. And the biggest challenge is that the very challenges that could derail the market are as unpredictable as they can get. Proceed with a smile on your face in the Indian markets, but definitely stay on alert. On that note, let's head now to the final segment, Dr. Dissects, where after a long wait, finally the biggest beneficiary of the AI revolution goes under the microscope one more time, once again, especially after that beneficiary has kind of become a political football in the ongoing trade war between the United States and India. I'm of course talking about semiconductor giant, one of the most valuable companies on planet Earth, Nvidia. Ticker symbol NVDA, okay? Nvidia stock has lost some of its charms, and that is definitely an understatement. Okay, ever since the release, I mean, that's definitely an understatement. I'm saying it's lost some of its charm, sure, but it's an understatement. It's been absolutely pummeled ever since the release of DeepSeek's cost-effective R1 model earlier this year. The stock has been absolutely destroyed once the US-China trade war ratcheted up. So far, year to date, the stock is down 22.5%. Neither the impressive Q4 earnings numbers nor the massive announcements made at the company's popular GTC conference were able to stem the overall negative sentiment in the stock. Investors continue to question whether at some point the cost effectiveness would spread from DeepSeek to the US hyperscalers such as Amazon, Google, Microsoft. Google confirmed that it is not affected by DeepSeek. They're continuing to spend, but Amazon and Microsoft, we still don't know. We'll find out in a bit, which would subsequently be a significant headwind for Nvidia. At the same time, the latest news that it could face a $5.5 billion hit to its margins courtesy of export controls to China hasn't helped the sentiment either. Finally, Huawei also launched a competing chip that could compete against Nvidia, again driving negative sentiment on the stock. The question, though, I have to ask, and I ask as an existing investor in the name, one of the biggest positions in my portfolio, so I have to ask, is whether this growing disconnect between investor and management sentiment, something that was also highlighted by Barron's recently, is warranted in the first place. In other words, has management simply been bluffing, as the godfather of AI, Jensen Huang, just simply been bluffing? Or is it that instead of irrational exuberance, investors are going through a bout of irrational fear when it comes to Nvidia? To answer this question, one must take a look at all the developments since the DeepSeek saga has happened. And the most important observation, which would support the irrational fear argument, would be that there is absolutely zero slowdown in capex spending by any of the major US players. On the contrary, all major AI players announced a significant year-over-year increase in their capex spending during their recent earnings call. Now, I know Microsoft and Amazon are announcing later this week, but there is no indication that they are going to change their tune. The latest earnings reports of these companies were released post the DeepSeek saga, which happened on 27 January 2025, which suggests that the cost-effective R1 model of DeepSeek had absolutely no bearing on the spending trajectory of these companies. Microsoft, in the last earnings call, and it's releasing tomorrow, I don't see any changes that's going to happen, is expected to spend $80 billion in capex, which is up 42% year over year. Meta has allocated 65 billion, which is up 62.5% year over year. Alphabet confirmed in their earnings report last week, it allocated 75 billion, then confirmed that it is continuing to, it is expected to spend 75 billion this, there is no change to it. And that's up 43% year over year. And Amazon is targeting $100 billion in capex. Again, it came out and said there is no capex slowdown, no data center spend slowdown. So that's up 20%, 20.5% year over year. So there's absolutely no change in the narrative that the hyperscalers plan to spend when it comes to building their AI capacity. DeepSeek may have led to a mini rout in the stocks of major AI players, but Nvidia still has the Chinese company to thank for the significant increase in AI-related spending. The release of DeepSeek has resulted in a shift in the company's plans from building conventional large language models to building reasoning models as well as AI agents. Both reasoning models and AI agents consume a lot more computing power and resources, which further lends support to the notion that NVIDIA's chips would be in high demand for the foreseeable future. One could argue, obviously, that even if more computing power is required, other AI players could simply copy DeepSeek and opt for NVIDIA's cheaper Hopper chips rather than the more expensive Blackwell, which could dent NVIDIA's margins going forward. It's highly unlikely to happen though, because by every comparison metric, Blackwell is miles ahead of Hopper. And Blackwell is more capable of training reasoning models and accelerated computing compared to Hopper, thanks to its features being more superior compared to Hopper. For instance, Blackwell's 5th gen NVLink interconnect has a data transfer speed of 1 terabytes per second compared to Hopper's 900 gigabytes per second, double. Blackwell's 2nd gen transformer engine doubles throughput while halving memory requirements thanks to its FP4 precision, a feature that Hopper doesn't have. More importantly, Blackwell is more energy efficient than Hopper, offering a higher 25x energy efficiency per watt, which would result in energy costs being reduced by $1.3 million per year. The overall takeaway from these comparisons is that Blackwell is simply more efficient than Hopper, and with more computing power required as the world moves from conventional large language models to reasoning models, the whole argument that cheaper Hopper chips would prevent companies from spending on Blackwell is a false one, in my opinion. Overall, from this, the main takeaway from all of this is the rationale for the disconnect between the investor and management sentiment makes absolutely zero sense to me. DeepSeek is a great innovation in my opinion, and what it has achieved is simply brilliant. However, to make a categorical conclusion that it would lead to a reduction in capex spend is absolutely far-fetched in my opinion. To claim that the arrival of DeepSeek means the death of Blackwell is even more ludicrous in my opinion. When one looks at the features of Blackwell, it is more efficient than Hopper, as mentioned earlier. In a world that requires more computing power as we move to the age of reasoning, efficiency is what companies look out for. As such, undermining Blackwell only increases the probability of investors living to regret their decision to overlook Nvidia's stock at current levels. That's not all, guys. There's another takeaway from the recent developments in Nvidia's, in Nvidia, the company, which obviously has an impact on Nvidia, the stock. The other takeaway that I want to discuss with you is from NVIDIA's recently concluded GTC conference was the comments made by CEO Jensen Huang on the concept of AI factories, which are computing architectures that oversee the complete AI lifecycle. During his GTC keynote address, Mr. Huang predicted that the total addressable market for these AI factories is close to $50 trillion. Now, despite the positive updates on AI factories, investors hardly got excited about the whole concept. Now, I'm not arguing that they should be going gung-ho about it and start buying the stock on a massive scale, but to not show even a glimpse of positivity surrounding this development was frankly surprising to me. This is because this is not the first time that Mr. Huang has talked about AI factories. During the third quarter earnings call, 2 quarters back, the company did mention that the adoption of its Omniverse platform was rapidly progressing, and the company even announced a partnership with Foxconn to build Taiwan's fastest AI supercomputer. Even during this year's GTC, the company announced partnerships with General Motors to integrate AI into the company's manufacturing. And in my last article, the last time I talked about Nvidia, I talked about the market for industrial AI is expected to grow at a CAGR of 46% by 2032. Once again, for AI factories to take shape, Blackwell would need to be at the forefront, a point that lends further support to why companies are in no way, shape, or form going to ditch Blackwell and keep using Hopper. And looking ahead, during the GTC, NVIDIA also unveiled its next generation of chips called Blackwell Ultra and Vera Rubin, set to be launched in the second half of 2025 and 2026, respectively. Rubin is designed in a way that would drive the cost down significantly. I'm not going to talk too much about it, Rubin, today. But the fact that NVIDIA has unveiled these more efficient products further demonstrates the significant potential of industrial AI and AI factories. Listen, Nvidia is not a short-term play, in my opinion. It never has been, never will be. Sure, you can make money by trading the name, or you lose money by trading the name. But one looks at the company's modus operandi, then one would see that this functions by long-term view, by taking a long-term view. It is this view that has led the company to being the most dominant player and the biggest beneficiary of the AI revolution. There is absolutely zero evidence, in my opinion, based on both its Q4 earnings report and on the development seen at the GTC, that its leadership position is under any threat whatsoever. That brings to me a book and a pen that can only mean one thing: valuation. Nvidia currently trades at a forward price to earnings of 24x, according to LSEG data, which makes it cheaper than Intel and Broadcom, but marginally more expensive than AMD. Now, if one looks at the EPS growth for FY25, then Nvidia, according to LSEG data, has the highest EPS growth among its peers. Intel, which is more expensive, trading more expensive than Nvidia, actually the projected EPS growth is negative. So doesn't make any sense. I have to rattle my brain there just to have to recheck the numbers just in case. But it's true. It's negative, but it's still more expensive than Nvidia. Anyway, as such, the current forward price to earnings multiple is not where the stock needs to be trading, in my opinion. Furthermore, the company's projected EPS growth in FY25 is significantly above the long-term average EPS growth. So in my opinion, Nvidia at a minimum should be trading at its historical multiples. Now, its 10-year historical forward price to earnings is 34.3, which is similar to its 2-year historical median forward PE. As such, I have assumed a forward PE of 34.3x for Nvidia. Okay, 34.3x, which is higher than my previous assumed multiple of, which is lower than my previous assumed multiple of 36.6 times. Now, I have lowered the PE multiple because the projected FY25 EPS growth is 53.04%, and that's lower than my previous estimate of 57.7%. Now, at a growth rate of 53.04 for FY25 EPS, is expected to come in at $4.58, right? Expected EPS is $4.58, and that's because there's an EPS growth of 53.04%, 53.04%, okay? 53.04% is the earnings growth. Put simply, now you take 34.3, multiply that by 4.58, and you get a price target of $157, now, which is $157 is lower than my previous price target of 167, but it still represents about 38% from current levels after accounting for the drop in Nvidia seen at the time that I was recording this show. Okay. Now, despite a significant upside from current levels, the stock has very poor short-term momentum, as evidenced by a grade of C on Seeking Alpha's momentum scale. As such, I'm maintaining my buy rating on the stock. I'm not upgrading to a strong buy. 157, its stock closed at about 105, 104. It's about 38-40% upside from current levels. So I'm maintaining my buy rating, price target of 157. Upgrading buy rating, price target 157. And the reason why I'm keeping it at buy and not a strong buy is because of the weak short-term momentum. So when it's still a bull case though, and when it's a bull case, I have to outline the risk factors, right? The main risk factor to my bull case is the China factor. More specifically, as part of the tariff wars and the arrival of DeepSeek, current Trump administration could strengthen the already strict export controls, and they're already doing that, and that could affect the company's China business even more. At the same time, there was a news report from Financial Times recently that mentioned that Chinese regulators are discouraging the country's tech companies from getting their hands on Nvidia's H20 chip, which is the Hopper chip, since the regulators believe that the chip breaches the country's energy efficiency rules. The other risk factor is obviously due to a slowdown or a short-term hit to their earnings growth, the major AI players cut their capex spending. Now, while this is an unlikely scenario or point that was reconfirmed by Alphabet's earnings last week, investors should never rule it out entirely. Moreover, should another DeepSeek-like saga happen, that would also be a significant hit to my bull case on Nvidia. Bottom line, Nvidia had a solid fourth quarter and also hosted a GTC conference whereby it gave convincing evidence that the future of AI revolution is strong and that it has the tools required to keep being the biggest beneficiary. Now that the Blackwell production is in full swing, the company is better positioned to meet the surging demand. The DeepSeek saga has actually been a blessing to the company, in my opinion, as it meant that the entire AI revolution moved to the next phase of building reasoning models and agentic AI, which requires significantly more computing power. There is no way that DeepSeek's use of Hopper would kill demand for Blackwell. The GPU is a lot more efficient in every single metric compared to Hopper and is more capable of producing more accurate reasoning models. Furthermore, in addition to this move towards more reasoning models, CEO Jensen Huang also stressed upon how the world is moving towards AI factories and robotics, which could be a $50 trillion opportunity. This industrial AI and its potential was mentioned by the company in the previous quarter as well when it announced a partnership with Foxconn. Mr. Huang offered more details this time around and also announced several partnerships on this front, including one with General Motors. Despite all these positive developments, there is a growing disconnect between investor sentiment and management sentiment. To me, guys, this simply makes no sense. I would have understood if the management simply used colorful, glowing words to describe their business and the potential of their business. However, they're not doing this, but they are actually backing it with solid evidence and numbers, as evidenced by yet another strong quarterly performance. At the same time, the major AI players are showing no signs of slowing down their capex spend even after the DeepSeek saga. On the contrary, they've all significantly increased their capex spend, another testament to the strength of Nvidia's business. Time and time again, I have mentioned that Nvidia is a company where investors have logic-defying expectations. This time, however, though, investors, in my opinion, might have gone one step too far. My concern is that by the time they realize this error, the Nvidia gravy train, might have already left the station. That's all the time I have for you this week. My goodness, time does fly when I record this episode, isn't it? If you have a specific Indian or US stock suggestion for the doctor to diagnose and dissect, do tweet me at Uttamvinay, UTHAMVINAY, or email me on thestockdoctorpodcast@gmail.com. Thank you once again for listening. I will see you next week. Until then, stay safe and make some money.